Welcome back to another episode of JRNY TV, your go-to source for everything digital finance. If you've ever wondered how the cryptocurrency market actually works, beyond the hype, beyond the price swings, and beyond the social media buzz, this video is for you. Crypto isn't just about Bitcoin. It's about an entire ecosystem driven by blockchain technology, market psychology, and global adoption trends. Understanding how the market functions is key to making informed investment decisions, avoiding costly mistakes, and spotting opportunities before they go mainstream. At its core, the cryptocurrency market operates very differently from traditional financial markets, like stocks or Forex. Unlike the New York Stock Exchange or NASDAQ, which have set trading hours, the crypto market is decentralized, running 24/7 without a central authority. This is because cryptocurrencies, they exist on blockchain networks, with transactions that are validated by a distributed network of nodes or computers, rather than a central institution. This constant activity means that price movements can be highly volatile, driven by factors such as trading volume, liquidity, and major news events. But beyond the technical side, the crypto market is fueled by a unique mix of retail traders, institutional investors, and even governments now exploring blockchain adoption. Speculation plays a significant role with traders looking for the next 10x or even a 100x opportunity. But there's also a deeper technological revolution that's happening in the background. From DeFi, decentralized finance, to real-world asset tokenization, crypto is reshaping how value is exchanged globally. In this deep dive, we're going to break down the mechanics of the market, explore the key players, and help you navigate the opportunities and the risks that come with it. At the heart of the cryptocurrency market lies blockchain technology, the decentralized, immutable ledger that powers every single digital asset. Unlike traditional databases that are controlled by banks or corporations, blockchains, on the other hand, they're maintained by a distributed network of computers, specifically cryptographic computers, that verify transactions without the need for a central authority, like a bank. This system ensures transparency, security, as well as trust, as every single transaction is permanently recorded and can never be altered. Different blockchains, they serve different purposes, from Bitcoin's simple but secure payment system to Ethereum's smart contract functionality that enables decentralized applications known as dApps. The type of blockchain a cryptocurrency operates on can significantly impact its market potential. Layer 1 blockchains like Ethereum, Solana, as well as Avalanche serve as the foundation for entire ecosystems, while Layer 2 solutions like Arbitrum and Polygon enhance scalability by processing transactions off-chain. Meanwhile, interoperability-focused networks like Cosmos and Polkadot, they aim to connect blockchains, ensuring seamless communication between ecosystems. Understanding how these different blockchains work is crucial for evaluating which cryptocurrencies have the strongest fundamentals and long-term staying power. Blockchain technology also influences key market trends such as decentralization, security, and scalability. For example, Bitcoin's proof-of-work system prioritizes security and decentralization, but it comes with the cost of slower transactions and higher energy consumption. Meanwhile, newer blockchains like Ethereum and Cardano have both adopted proof-of-stake models that improve efficiency while maintaining security. These underlying mechanics play a crucial role in determining which projects gain adoption and which struggle to stay relevant in an increasingly competitive market. Cryptocurrency prices are driven by a unique combination of supply and demand dynamics, investor sentiment, as well as market speculation. Unlike traditional assets such as stocks, which are often valued based on company earnings or economic indicators, crypto assets derive their value from factors like network utility, adoption rates, as well as overall market psychology. Bitcoin, for example, Bitcoin has a fixed supply of 21 million coins, making it inherently scarce, an attribute that continues to fuel its digital gold narrative. Meanwhile, altcoins like Ethereum, they gain value through their ability to support decentralized applications known as dApps, smart contracts, and tokenized economies. Another major influence on cryptocurrency prices is liquidity, which refers to how easily an asset can be bought or sold without significantly impacting its price. Highly liquid assets like Bitcoin and Ethereum tend to have smaller price fluctuations simply because there are enough buyers and sellers to absorb the market movements. However, low-cap altcoins or meme coins, they often experience extreme volatility, as even a single large transaction, it can trigger massive price swings. Exchange listings also play a role. When a cryptocurrency gets listed on a major platform like Binance or Coinbase, for example, it often sees a surge in price due to increased exposure and trading volume. Beyond the fundamentals, crypto prices are heavily influenced by macroeconomic trends and regulatory developments. When central banks tighten monetary policy, risk assets, including cryptocurrencies, often decline as investor sentiment shifts towards safer investments. Conversely, bullish cycles are fueled by a combination of institutional adoption, favorable regulations, and mainstream interest. The very rise of spot Bitcoin ETFs, for instance, has opened up the floodgates for traditional investors, further legitimizing the crypto market. And understanding these price mechanisms is crucial for investors looking to navigate the volatile nature of cryptocurrency markets effectively. Cryptocurrency exchanges are the backbone of the digital asset economy, providing a marketplace for traders to buy, sell, as well as swap tokens. They fall into two main categories: centralized exchanges, CEXs, like Binance, Coinbase, and Kraken, and decentralized exchanges, known as DEXs, like Uniswap, PancakeSwap, and DYDX. Centralized exchanges operate very similar to traditional stock markets, offering high liquidity, user-friendly interfaces, and security measures, but they require users to trust a third party with their funds. Decentralized exchanges, on the other hand, they use blockchain technology and smart contracts to enable peer-to-peer trading without those intermediaries, providing greater transparency and user control. However, they often suffer from lower liquidity and more complex interfaces. Market makers play a crucial role in ensuring smooth trading by providing liquidity to exchanges. Without market makers, trading pairs would experience high volatility and significant price slippage, making it difficult for traders to execute large orders efficiently. On those centralized exchanges, market makers are often professional trading firms using algorithmic strategies to provide continuous buy and sell orders. In DeFi, liquidity providers fill a similar role by locking assets into liquidity pools in exchange for a share of trading fees. This mechanism enables decentralized exchanges to function without order books, instead relying on automated market makers, known as AMMs, to determine prices based on supply and demand. While exchanges and market makers keep the crypto market liquid and efficient, they also introduce risks. Centralized exchanges can be hacked, face regulatory crackdowns, or even become insolvent. Events like that have led to major collapses, like FTX in 2022. DEXs, though, more resistant to centralized failures, are more vulnerable to smart contract exploits and impermanent loss for liquidity providers. For traders and investors, understanding the different types of exchanges and liquidity providers, it is key to navigating the market effectively while managing risk exposure. Whether you're opting for a centralized platform for convenience or maybe a decentralized exchange for sovereignty, choosing the right trading venue is a fundamental step in crypto investing. The cryptocurrency market has evolved far beyond its early days of niche internet forums and underground trading. Today, institutional adoption is a driving force behind the maturity of digital assets, bringing a new level of legitimacy as well as stability to the space. Major financial institutions, hedge funds, and publicly traded companies have all begun allocating capital to cryptocurrencies, with Bitcoin leading the charge as a store of value. And the approval of Bitcoin spot ETFs, it's opened up the door for traditional investors, allowing exposure to crypto without the technical complexities of self-custody. Additionally, major banks like JP Morgan and Fidelity now offer crypto-related services, signaling a broader acceptance of digital assets with mainstream finance. Beyond Bitcoin, institutional interest is continuing to expand into areas like Ethereum smart contract ecosystem, real-world asset tokenization, and blockchain infrastructure projects, just to name a few. Chainlink, for example, has partnered with major banks and financial institutions to provide decentralized data feeds, while Ethereum's transition to proof of stake has made it more appealing to institutional investors that are seeking sustainable blockchain solutions. Even hedge funds are now exploring yield-generating opportunities in decentralized finance, known as DeFi, leveraging liquidity pools and staking protocols for passive income. That's right, earning while you sleep. This growing institutional presence not only injects capital into the market, but also improves liquidity and reduces volatility over time. However, the involvement of institutional capital, it also introduces new dynamics that retail investors, they must consider. Large players operate under different risk management strategies, and their actions, such as mass liquidations, regulatory lobbying, or maybe coordinated market movements, they can all impact prices significantly. Additionally, as regulators tighten their grip on the industry, institutions everywhere often advocate for policies that may benefit them at the expense of retail traders. Please do keep that in mind. While institutional adoption undoubtedly strengthens the crypto market, it is essential for everyday investors to please stay informed on how these developments continue to shape the broader ecosystem. The rise of institutional participation signals that crypto, it is here to stay, but it also means the game is evolving, and the rules, they may not always be in favor of the retail traders. Understanding market cycles is crucial for anyone looking to navigate the cryptocurrency space effectively. Like traditional financial markets, crypto operates in boom and bust cycles, driven by investor sentiment, liquidity, and macroeconomic conditions. These cycles, they often begin with a period of accumulation, where those savvy investors, they buy the assets at low prices while the broader market remains skeptical. This This is followed by a breakout phase where positive news, increased adoption, and media hype drive the prices upward, then leading to a full-fledged bull market. During this stage, you already know, FOMO, that fear of missing out, strongly kicks in, thus drawing those retail investors in at an increasingly higher valuation. However, no bull run lasts forever. Remember that. Eventually, the smart money begins to take profits, liquidity then dries up, and the market transitions into a distribution phase. This is where euphoria turns into fear, and those over-leveraged traders, they get wiped out as corrections deepen. What follows is the bear market, a painful but necessary reset that eliminates unsustainable projects, flushes out speculative excess, and allows the strong fundamentals to take center stage once again. Historically, Bitcoin's halving events, they have acted as catalysts for these cycles, reducing mining rewards and sparking supply shocks that drive renewed demand. Many altcoins follow Bitcoin's lead, experiencing exponential gains in bull markets and then severe drawdowns in bear markets. Recognizing these patterns, they can provide a significant edge for any investor. Those who accumulate during bear markets and then take the profits in bull runs, they tend to outperform those who chase those pumps and panic sell in downturns. Timing the market perfectly is nearly impossible, but understanding the psychological and economic factors that are behind these cycles, it can help investors make more rational decisions. The key is to maintain a long-term perspective, diversify intelligently, and avoid emotional trading. That's right, remove emotions entirely. While crypto market cycles can be volatile and unpredictable, they do follow a historical rhythm that rewards patience and strategic planning. The future of cryptocurrency is being shaped by a combination of technological innovation, regulatory developments, as well as growing mainstream adoption. Blockchain technology continues to evolve with advancements like zero-knowledge proofs, layer 2 scaling solutions, and real-world asset tokenization paving the way for greater efficiency and broader utilization cases. Ethereum's continued upgrades, Bitcoin's layer 2 Lightning Network, and the rise of multi-chain interoperability protocols like Cosmos and Polkadot are both pushing the industry toward a more interconnected and scalable future. Meanwhile, decentralized finance, DeFi, and non-fungible tokens, those NFTs, are undergoing their own transformations, with real-world integrations becoming more prominent. Regulation remains one of the biggest uncertainties facing the industry, but it also presents opportunities for legitimization and institutional growth. Governments around the world are currently working to establish clearer frameworks for crypto taxation, compliance, as well as investor protection. While some fear regulation could stifle innovation, others, they argue that well-structured policies, they could reduce fraud, increase institutional participation, as well as create a more stable market. The very approval of Bitcoin ETFs and ongoing discussions about central bank digital currencies, it signals that traditional finance is finally preparing to coexist with and even embrace crypto. However, the tug of war between decentralization and government oversight, that will remain a defining theme in the years ahead. Looking forward, the next decade will very likely see cryptocurrency becoming an integral part of the global financial system. From gaming and social media integrating digital assets to AI-driven trading strategies optimizing market efficiency, the scope of blockchain applications is vast. As adoption continues to grow, the market will inevitably mature. Speculative bubbles will become less extreme, and real-world utility use cases will take center stage. Whether we're headed for a future dominated by Bitcoin, decentralized networks, or entirely new innovations, one thing is definitely clear. Cryptocurrency is very much here to stay, and those who understand the space now will be best positioned to capitalize on its long-term evolution. And there you have it. The cryptocurrency market is a complex and dynamic ecosystem, but as we've seen, it's full of exciting opportunities for those who are willing to learn, adapt, and then dive in. With blockchain technology continuously evolving and new use cases emerging every single day, the very potential for crypto to revolutionize various industries is limitless. But now we want to hear from you. What do you think the future of cryptocurrency holds? Do you agree with the predictions that we've shared? Or maybe you have your own vision for the next big shift? Drop your thoughts in the comments below. Let's get into the conversation. And don't forget to hit that like button, smash that subscribe, and turn on those notifications so you never miss our next deep dive. Your engagement helps us grow and continue bringing you the very best analysis. Remember, the future belongs to those who start preparing for it today. Thanks again for watching JRNY TV. We will see you in the next one.